where we're talking business assurance and how to plan against potential disaster. Still with me in studio is Raylan Dunbar, financial advisor at FinLogic, and Michelle Human, legal marketing advisor at Liberty. Now, before we continue with our discussion, let's take another look at a quick question that we received from a viewer. This one comes from Edward in Pretoria, and he wants to know, I own shares in a company through a trust. How can I structure a buy and sell agreement through that? Going into the break, I know we chatted about going into a loan account. We are going to get to it. I think let's just quickly pick up on the question at hand. Raylan, I've got a situation like that. How do I then go about structuring my buy and sell agreement?
You can still structure a buy and sell agreement. The only concern though is that you're contravening one of those P's. So you're in a position where you're not necessarily the actual partner in the business at the time of death. Your trust is effectively the partner in the business, and effectively the trust is its own entity and not part of you. So that's really important to take that into consideration. This could also happen with a company or a CC owning shares in another company, because you're in a position where you as a person are not necessarily owning it in your own right, you're owning it through another entity. Now, if that is the situation, what needs to be done is that estate duty will be charged. There's just no way around that. And I mean, there has been government notes that have come out from SARS to say that there will be estate duty charged in those events. So it's really important, and the easiest way to really do it is to just increase the value of your policy by 25%, so that you've got the 20% available on the full and increased amount to be able to pay your estate duty. So that's your quickest, easiest calculation. That way, also through the life insurance company, they effectively paying your estate duty, which works out to be a lot cheaper than paying a massive 20% on a large value.
Sure, absolutely. Michelle, I mean, this probably goes, this type of scenario goes to what we were chatting about sort of before the show, and that's really, if I'm in a one-man band or I've got my own business and I've got no real partner to speak of, it could either be a key person that I have in the business or perhaps somebody in the industry that I can then hand that business over to. We can structure a buy and sell agreement. The only thing we're sacrificing on is that estate duty.
Remember, the key question once again is, do you have a succession plan? And we're not necessarily saying that you can only sell your shares to a partner. You alluded to the fact that maybe you're a one-man show and there is no other partner. Identify anybody who would be willing to buy your business effectively on your death or disability and go into a buy and sell agreement with them. The fact that you're going to breach one of our 3 Ps doesn't necessarily mean that you can't do a buy and sell agreement. The contract is still very valid and very worthwhile. It just means that you need to provide for estate duty.
Yeah, sure.
We very often see that, especially with health professionals or attorneys and that type of thing, because they can't necessarily have their own company or whatever the case in terms of how it's structured. It's more of an incorporation. So what would normally happen is that, say for example, 2 doctors who work perhaps in the same building say that if anything happens to me, you'll take over my practice, and vice versa. Now, an actual buy and sell agreement contract could be set up to actually implement that. Again, you don't necessarily own shares in each other's business, so you will pay estate duty, but at least you have a full succession plan in place to make sure that there's a continuity in your business.
Sure, absolutely, and some certainty for your family as well. Michelle, I mean, we were going to turn our attention to loan account. Let's do it now.
Okay.
We had the situation where the company owed me money, or sorry, I owed the company money through the premiums, but what about those that have put money into a company and kept it there as working capital? That's an asset that they need to extract when they go about selling their business in the event of disaster. How do we plan for that?
Definitely. You know, you've alluded to it, but there are 2 different types of loan accounts that we have. We've got a credit loan account and we've got a debit loan account. Credit loan account is the situation that you mentioned now, where the company actually owes you money. And when you leave, be it death, disability, retirement, the company actually has to pay that debt back. Debit loan accounts the other way around, where you owe the business money. And same thing here, if death, disability, retirement, resignation even, that loan is going to have to be settled. And you can very easily do that as part of your buy and sell agreement. So if, for example, I were to pass away, you're going to buy my shares in the business, you're also going to buy my loan account. And the Estate Duty Act actually makes specific provision for that, in that it says that you purchase any shares or like interest in the business. And there's your loan account coming through. So therefore, you're meeting your estate duty requirements, and it simply forms part of your purchase.
But again, if we had to strip it then out, assuming I don't have a partner, assuming I don't have anything to sell as a business, maybe I'm a service company, when I go, it goes. Surely their loan account should be extracted some way, or was that just part of the asset that will be in your estate ultimately?
Well, definitely. You know, there are different ways in which you can structure it. The first way, as we mentioned, is part of your buy and sell agreement. The second way is that it could be part of a standalone arrangement, whereby you insure for the value of that loan, so that you know that on your death or disability, those funds are immediately going to be available to the business to be able to settle that loan to your estate.
Alan, talking about things being owing, one of the biggest risks I guess most business owners face is signing personal surety when going and leveraging with a bank. Let's talk contingent liability quickly.
All right, this is really a very, very important part, and very often you find that in terms of working capital as such in a business, a lot of individuals or directors or members in a CC, etc., are in a position where they are signing personal surety on behalf of the company. And what's even more scary is that that very often is in a position where it's an unlimited surety. Now, how, as a financial advisor, do you actually put a number onto that and really protect your client in that way? It's a very, very difficult question. And I mean, in the past, the company could sign its own surety ships, but banks have realized that it's very easy to make a company insolvent or liquidate it or whatever the case. And now you're in a position where they cannot get their money back. So that's why they go after the individual to say, you are signing surety on behalf of the business. Now, the easiest way to really do that, again, and the cheapest way and the most cost-effective way is, again, through a life insurance policy. Sure. The reason for doing that really is setting up what they call a contingent or personal liability plan. Now, that's really to protect your estate, because remember, if anything has to happen, let's say I have to pass away and I've signed surety for the company, and let's say there's R1 million outstanding to the bank. The bank at that point in time, even though possibly 5 other directors have also signed for surety, the bank has the right to come back to my estate and claim that full R1 million. So what really happens is that by setting up a policy as a contingent liability plan, you're now in a position where the capital is provided and effectively it can be paid over. Again, though, with contingent liability plans, just be aware that there could be an estate duty implication, because effectively you're alleviating your own estate. So if it shows in terms of the way that that exemption really works, is that your personal estate is benefiting, and for that reason there could be an estate duty implication.
Estate duty implications. Now, a one-man band, all right. Do I then set it up through a contingent liability, or do I just add it to my personal insurance?
It's always a nice idea to keep the business liabilities separate. Now, in a one-man band, you don't have that distinction between personal estate and your business estate as such. So that's probably not going to make too much difference. But I think so many people these days prefer not to set up a business as a one-man band. They go into a partnership, a closed corporation, or a company for that very reason. They want the limited liability. They want the perpetual succession. And then they go and sign personal surety, which effectively is undoing all those risks that they were trying to avoid by setting up that separate entity. And in order to have that financial freedom, to have that peace of mind, having a personal liability plan in place is really the solution.
Okay. So again, you're creating that certainty. I mean, the common thread that seems to be coming through, if we're going to look at business insurance, we're going to look at protecting the risks of being in business for yourself. Structuring becomes incredibly important, and potentially having life insurance and disability insurance for that matter as a funding mechanism perhaps is a way to actually structure and mitigate some of that risk. Okay. Michelle and Brandon, thank you so much for your participation tonight. It was a wonderful discussion. We haven't covered what we wanted to, but certainly the next show we're going to pick up on that. Before we say goodbye though, it's time for a quick look at our weekly viewers' tips. This week, of course, they relate to business insurance.
If you own a portion of a business, you and your business partners will need to set up a buy and sell structure. Funding this structure through life assurance is a cheap and effective solution. There are a few things to remember. Firstly, make sure you have a valid and legal buy and sell agreement in place. If you don't and you pass away, your business partner is under no legal obligation to pay the proceeds of your policy to your family. Buy and sell agreements must be regularly reviewed and updated every time there is a change in the value of your business or a change of ownership. Ensure that your business is valued and insured at fair market value. Don't inflate the value, as donations tax of 20% will be levied on the inflated amounts. If a buy and sell structure is correctly implemented through life assurance, the policy will be free of estate duty and capital gains tax. If you allow the premiums of the buy and sell policies to be deducted from the company's bank account, make sure that you allocate the correct proportion of the premium to the owner's loan account monthly. Should a business partner die and this hasn't been correctly allocated, the estate duty exemption will fall away and 20% of the policy proceeds will be lost to tax. I often find company accountants claiming tax deductions on the premiums of buy and sell policies. This is illegal. If this has happened in your business, contact an advisor immediately so that the structure can be corrected. The estate duty exemption will not be allowed if you hold your share of your business in a trust, company, or a CC. The exemption only applies to those who own business shares in their own name. In terms of Section 38, companies and CCs can now buy back its own shares if certain criteria are met. This can be achieved by the company or CC owning the full or part of a buy and sell policy. Although there is no CGT payable on the buy and sell policy if ownership has not changed, remember CGT is still payable on the sale of the actual shares. So make sure that you have funds for this, as on a large company value, it could be a substantial amount. If you are running a loan account in a deficit, it's important to remember to add the value owed to the business to your buy and sell policy, and not to a key person policy. If you've signed surety in your own personal right for a company, a contingent or personal liability policy must be established to protect your estate and ultimately your family. As in the event of your death, the creditor may call in the surety and your estate will be liable for the payments. It was previously thought that if Section 3A of the Estate Duty Act was met, there would be no estate duty implications. However, this is incorrect. A recent SARS practice note stipulates that estate duty will be charged as the deceased estate is benefiting from the repayment of the surety. If a contingent liability plan is owned by a company, it can be made conforming in terms of Section 11W of the Income Tax Act. Remember, if it is conforming, you're entitled to a tax deduction on the premium, but the full proceeds will be taxed at the company tax rate of 28%. The last and most important advice that I can give you is make sure that you get the right financial advice from a specialist advisor in business assurance, as advisors who do not focus on this business often give incorrect information. If you would like to have your current structure checked, please contact FinLogic.